Listen very carefully to what I'm about to tell you. The Bank of America just released research that should fundamentally change how you think about the silver market right now. Not because of manipulation theories, not because of conspiracy nonsense, but because of something far more powerful and far more real. Retail investor flows are creating market dynamics that could push silver to $170 per ounce within 2 years. And the data behind this projection reveals something most investors completely miss about how precious metals markets actually move. This isn't about ancient gold to silver ratios or mystical technical analysis. This is about supply and demand meeting market structure in ways that create explosive price moves. And Bank of America just documented exactly how this mechanism works, why it's happening right now, and what it means for anyone holding or considering silver positions. By the end of this video, you're going to understand why retail flows matter more than institutional positioning in tight commodity markets. You'll know exactly what Bank of America is modeling when they say $170 is plausible, not guaranteed, but genuinely possible. And you'll understand whether the current retail surge represents the beginning of something massive or the end of a temporary spike. Let's start with the single most important thing everyone gets wrong about this Bank of America forecast. The financial media headline says Bank of America predicts silver will hit $170. That's false. What Bank of America actually said, according to their research reported by Investing.com and TipRanks, is that if retail investor flows continue at the pace observed in the third quarter of 2025, silver could reach $170 per ounce within approximately 2 years. That conditional statement is everything. If flows continue, could reach within 2 years. Those aren't predictions. Those are scenario parameters. Bank of America is doing what professional analysts do. They're modeling what happens if current trends persist under specific conditions. They're not saying those conditions will definitely persist. They're saying, here's the math if they do. The difference between could happen if and will happen is the difference between scenario analysis and price prediction. Scenario analysis says, given observable trend X, if trend X continues at current rate, outcome Y results. That's modeling, that's quantitative research, that's showing your work. Price prediction says, we expect outcome Y. That's forecasting, that's conviction, that's putting your research reputation on a specific call. Bank of America is doing the first, not the second. They're giving you the framework and the conditional logic. They're not telling you to mortgage your house and buy silver futures. And understanding that distinction makes you smarter than 95% of people reacting to this news without reading the actual research methodology. So what exactly is Bank of America modeling? What are retail flows? Why do they matter? And why would continuation of third quarter patterns produce $170 silver? Let me break down the mechanism that drives this entire thesis, because once you understand it, you'll see why this analysis is both intellectually honest and genuinely concerning for anyone short silver or underweight precious metals. Retail flows means money from individual investors, not institutions, flowing into silver investment products, physical bullion purchases, silver ETFs like SLV, mining stocks, futures contracts held by non-commercial traders, and increasingly, silver exposure through crypto-backed precious metals tokens. According to Bank of America's analysis, as reported by Investing.com, retail investor positioning in silver increased dramatically during the third quarter of 2025. The data shows measurable acceleration in purchase volumes, ETF inflows, and physical delivery requests beyond typical seasonal patterns. This wasn't gradual accumulation. This was surge buying, and here's why that matters in ways that institutional buying doesn't. Silver's total investable market capitalization is relatively small compared to gold, equities, or even many individual large-cap stocks. According to industry estimates, total above-ground silver inventory held for investment purposes is roughly 2 to 3 billion ounces. At current prices around $80 to $85 per ounce, that's approximately $160 to $255 billion in total investment-grade silver globally. Compare that to gold's investment market of roughly $12 trillion, or Apple's market cap of over $3 trillion, or the S&P 500's total value exceeding $40 trillion. Silver is tiny. When large dollar amounts flow into tiny markets, prices move exponentially more than the same dollar amounts flowing into large markets. That's not theory, that's arithmetic. If $10 billion flows into silver investment products over 3 months, that's potentially 4 to 6% of the entire global investment silver market changing hands. The same $10 billion flowing into gold barely registers as 0.08% of that market. The smaller market experiences dramatically larger percentage price impacts from equivalent capital flows. This is the core mechanism Bank of America is modeling. Retail flows at third quarter rates represented X billions entering the silver market. If that rate continues, cumulative flows over 24 months equal Y billions. Y billions entering a market of total size Z produces price appreciation of approximately 100 to 120% from current levels, which gives you $170 per ounce. That's the model. That's the entire analytical structure. Flow rate times duration divided by market size equals price impact given historical elasticity assumptions. And the reason Bank of America published this specific scenario is because the third quarter data was genuinely unusual. Let me show you why the Q3 2025 retail surge matters and what makes it different from normal silver market activity. According to multiple sources tracking precious metals positioning, retail investor interest in silver during the third quarter reached levels not seen since the 2020-2021 meme stock and Wall Street Bet's silver squeeze period. Physical bullion dealers reported inventory constraints on popular retail products like American Silver Eagles, Canadian Maple Leafs, and generic silver rounds. Premiums over spot price, which normally run 2 to 4% for retail bullion, spiked to 8 to 12% for certain products indicating supply-demand imbalances. Silver ETF inflows, particularly in retail accessible funds, showed acceleration beyond typical patterns. Google search trends for terms like buy silver, silver investment, and silver versus gold all increased substantially during the quarter, indicating grassroots retail interest rather than institutional positioning. And perhaps most importantly, this surge happened while silver prices were already elevated in the $75 to $85 range, not at depressed levels where value buyers typically emerge. That behavioral pattern suggests momentum-driven retail participation, not bottom-fishing value accumulation. Retail investors were buying silver not because it was cheap, but because it was going up. And they were buying enough to move a market that, despite being small in absolute terms, still requires billions in capital flows to generate meaningful price appreciation. When Bank of America saw this data, they asked the obvious analytical question: what happens if this continues? Not will it continue, but what happens if it does? And the answer they calculated was $170 silver within 2 years under sustained flow assumptions. That's not wild speculation. That's straightforward modeling of observed trends, extended forward, with explicit assumptions stated. Now let me show you why retail flows create different market dynamics than institutional flows, because this distinction is critical to understanding why Bank of America focused specifically on retail participation rather than hedge fund positioning or central bank buying. Institutional investors, the hedge funds, pension funds, sovereign wealth managers, operate with different constraints and behaviors than retail investors. Institutions have position size limits, risk management protocols, redemption considerations, and typically shorter holding periods driven by quarterly performance measurement. When institutions buy silver, they're usually doing so as a tactical allocation, a relative value trade, or a portfolio hedge with defined entry and exit parameters. They're not married to positions, they're renting them for strategic purposes with clear risk-defined frameworks. That institutional behavior creates natural selling pressure whenever prices move significantly higher because institutions take profits, rebalance portfolios, and manage risk exposure systematically. Institutional buying creates its own ceiling through profit-taking dynamics. Retail investors, particularly those buying physical silver or holding long-term investment positions, operate completely differently. Retail silver buyers often view positions as insurance, wealth preservation, or long-term accumulation with no defined exit strategy. They're not managing quarterly performance. They're not answering to risk committees. They're buying and holding based on conviction, fear, opportunity, or simple belief that precious metals should be part of a diversified portfolio. Retail physical buyers rarely sell back into rallies. They accumulate into rallies. This is psychologically and behaviorally the opposite of institutional profit-taking. When silver rallies from $80 to $100, institutions sell into strength. Retail buyers see confirmation of their thesis and buy more. That asymmetric behavior creates momentum dynamics in retail-driven markets that don't exist in institutionally driven markets. Rising prices attract more retail buying, which drives prices higher, which attracts more retail attention, which drives more buying. This is the feedback loop that creates parabolic moves in relatively small, retail-accessible markets. Bitcoin demonstrated this dynamic from 2020 to 2021. Retail participation reached critical mass, created sustained buying pressure that overwhelmed normal profit-taking dynamics, and drove prices from $10,000 to $60,000 in roughly 18 months, despite institutional skepticism. Bank of America is observing similar early-stage dynamics in silver during Q3 2025 and modeling what happens if those dynamics persist rather than fade. The $170 scenario assumes retail participation doesn't burn out after one quarter, but instead continues for 6 to 8 quarters, creating cumulative flow pressure that overwhelms available supply at current prices. That's the thesis. That's what makes this projection both plausible and concerning, depending on your positioning. Now here's the part that makes Bank of America's analysis genuinely useful, rather than just another price target to ignore. They didn't just pick $170 out of thin air and reverse engineer a narrative. They built the scenario from observable Q3 flows forward using documented market size assumptions and historical price elasticity relationships. Let me walk you through the actual analytical building blocks they used so you can evaluate the methodology independently. Building block 1, Q3 2025 retail flow rate. According to Investing.com's reporting on the Bank of America research, retail investor flows into silver during the third quarter represented a significant increase over prior quarters. While exact dollar figures weren't publicly disclosed in the research summaries, the flows were substantial enough to warrant scenario modeling around continuation. For our purposes, let's call this quarterly flow rate F. The specific number matters less than understanding it was meaningfully above historical averages for retail silver participation. Building block 2, silver market size and available supply. Total global above-ground silver inventory for investment purposes is approximately 2 to 3 billion ounces, based on industry surveys and analysis from organizations like the Silver Institute. Not all of this silver is available for purchase at current prices. Much of it is held in strong hands, long-term holders who don't sell into rallies, central bank reserves, industrial stockpiles, and jewelry that doesn't flow back to investment markets easily. The realistically available supply for new investment demand is likely 20 to 40% of total inventory, somewhere between 400 million and 1.2 billion ounces that could theoretically be mobilized at higher prices. Building block 3, price elasticity of supply and demand. When silver prices rise, some holders sell, creating supply. When prices rise, some buyers step back, reducing demand. But in retail-driven momentum markets, demand elasticity can become inverted. Higher prices attract more buyers, rather than fewer buyers during euphoria phases. This is the rocket fuel that creates parabolic moves. Bank of America's model implicitly assumes that retail flows continue despite rising prices, which is observationally consistent with retail behavior in momentum-driven commodity markets historically. Building block 4, time frame and cumulative impact. If quarterly flow F continues for 8 quarters, that's cumulative flow of 8F. If 8F equals, hypothetically, $40 to $60 billion in cumulative new retail investment over 2 years, and if available supply is constrained to 500 million to 1 billion ounces, then prices must rise sufficiently to either bring new supply to market or dampen demand enough to clear. At $80 per ounce, silver needs to approximately double to $160 to $170 to create equilibrium under these flow assumptions. That's the math. That's the scenario. Sustained retail flows of magnitude F for duration T into market of size M with elasticity E equals price P2, where P2 is roughly double P1. Bank of America showed their work. They didn't just say $170 sounds impressive. They built it from observable Q3 data extended forward under explicit if-then conditions. You can agree or disagree with the assumptions about flow continuation, supply elasticity, or demand persistence, but you can't say they didn't document the analytical foundation. That's intellectually honest research. That's how professionals build scenarios. And that's why this analysis deserves serious attention, even if you think the $170 outcome is unlikely. The methodology reveals market structure vulnerabilities that matter regardless of specific price targets. Now let me show you the 3 reasons why Bank of America's scenario is plausible, not guaranteed, but genuinely possible under realistic market conditions. Because understanding plausibility versus probability makes you a better investor than blindly believing or blindly dismissing. Plausibility factor 1. Retail access to silver has never been easier. 40 years ago, buying physical silver required finding a local coin shop, paying huge premiums, arranging storage, and accepting zero liquidity unless you sold back to a dealer at significant discounts. 20 years ago, silver ETFs didn't exist. Retail investors could access futures contracts with huge margin requirements and complexity, or they could buy mining stocks with company-specific risks. Today, buying silver exposure is literally easier than ordering food delivery. SLV and other silver ETFs trade like stocks with zero commissions on most platforms. Physical silver can be ordered online from dozens of reputable dealers with transparent pricing and delivered to your door in 48 hours. Silver-backed tokens and crypto platforms offer fractional silver ownership with smartphone access. Retail investors who want silver exposure can get it in under 60 seconds with 3 clicks on their phone. This accessibility removes friction that historically limited retail participation. When retail interest surges, that interest can now convert to actual capital flows instantly without barriers. The ease of access amplifies the flow impact of retail sentiment in ways that weren't possible in previous precious metals cycles. Plausibility factor 2. Macroeconomic conditions support precious metals demand broadly. Whether you believe inflation is transitory, persistent, or accelerating, the fact remains that currencies globally have lost purchasing power substantially since 2020. The US dollar has depreciated against hard assets. Central banks continue expanding balance sheets despite rate normalization. Government debt levels exceed anything in peacetime history. Geopolitical instability remains elevated with active conflicts and trade tensions. These conditions create rational demand for hard assets as portfolio diversification and monetary insurance. Gold has already reflected this demand, rallying to all-time highs above $2,600 per ounce. Silver, as gold's smaller, higher volatility cousin, benefits from the same macro drivers, but with amplified price sensitivity due to smaller market size. Retail investors looking for precious metals exposure but priced out of gold ounces at $2,600 naturally consider silver ounces at $80 as accessible alternative. That substitution effect channels retail flows disproportionately toward silver during broad precious metals bull markets. The macro backdrop supports sustained retail interest in precious metals generally, which flows predominantly into silver due to affordability and accessibility at the retail level. Plausibility factor 3. Silver supply is genuinely constrained relative to demand growth. Unlike fiat currency, which can be created infinitely by central banks, silver is a physical commodity with mining production constraints. According to the Silver Institute's annual supply-demand reports, global silver mine production has been relatively flat for the past 5 years, at approximately 830 to 870 million ounces annually. Meanwhile, industrial demand for silver continues growing, driven by photovoltaic solar panels requiring roughly 20% of annual supply, electric vehicle production using silver in batteries and electrical systems, 5G infrastructure, and AI data center construction, all consuming silver in growing quantities. Investment demand adds on top of industrial demand. When investment demand surges, it competes directly with industrial users for available supply. Unlike gold, which is almost entirely investment and jewelry demand with minimal industrial use, silver faces genuine supply constraints when both industrial and investment demand are strong simultaneously. Bank of America's scenario implicitly assumes industrial demand remains robust while investment demand accelerates. That dual pressure on fixed supply is the supply-demand fundamental that makes $170 plausible if retail flows continue. This isn't about manipulation or conspiracy. This is about physics. There's only so much silver available annually. If demand exceeds that amount sustainably, prices must rise to either bring new supply online or destroy demand through price rationing. That's commodity market mechanics, not speculation. Put those 3 plausibility factors together, and Bank of America's conditional scenario makes sense. Retail access is unprecedented. Macro conditions support precious metals broadly. Supply is genuinely tight relative to combined industrial and investment demand. If retail flows continue at Q3 rates for several quarters, cumulative pressure on a small market with tight supply could produce explosive price moves. The scenario holds together analytically. It's not guaranteed because trends don't have to continue and markets don't move in straight lines, but it's plausible because the underlying mechanisms are real, documented, and currently observable. Now let me show you the 3 reasons why Bank of America's scenario might not happen, why $170 could be the upper bound of possibility rather than likely outcome. Because understanding the bear case makes you a complete analyst, not just a cheerleader for whatever position you're hoping works. Bear case 1, retail interest could fade as quickly as it emerged. Retail investor behavior is notoriously fickle. Retail enthusiasm for SPACs evaporated in 2021. Retail interest in meme stocks faded after 2021. Retail participation in crypto crashed from 2021 to 2022 before recovering. The Q3 2025 surge in retail silver buying could be a temporary enthusiasm spike rather than sustained trend. Maybe retail investors got excited about precious metals during Q3 due to specific news flow, social media momentum, or fear around specific events. Maybe they lose interest in Q4 or Q1 2026 as attention shifts to AI stocks, crypto, or whatever the next retail obsession becomes. If retail flows fade back to historical averages rather than continuing at Q3 rates, the entire $170 scenario evaporates. The projection is completely dependent on flow continuation. No continuation, no explosive price move. That's the single biggest risk to the bullish scenario. Retail interest is a light switch, not a dimmer. It's either on or off. And when retail loses interest in an asset class, flows don't decline gradually. They collapse. Bank of America's scenario assumes the light stays on for 8 quarters. History suggests that's a very aggressive assumption about retail attention span. Bear case 2, higher prices could mobilize supply that isn't available at current prices. Bank of America's model assumes available silver supply is constrained and relatively inelastic to price. But what if that's wrong? What if silver at $120, $140, $160 per ounce brings massive recycling flows, scrap supply, and strategic inventory releases that overwhelm retail demand? Industrial users sitting on large silver stockpiles might liquidate at prices 50 to 100% above current levels. Jewelry could flow back to market for melt value. Mining companies could accelerate production or restart mothballed operations. Government strategic reserves could be partially released. All of that potential supply is invisible at current prices, but becomes economically rational to mobilize at significantly higher prices. If $140 silver brings 200 to 300 million ounces of supply to market that's currently held off market, that supply flood could satisfy retail demand and cap prices well below $170. Supply elasticity in commodity markets is notoriously difficult to model because you don't know what supply exists at higher prices until those prices are reached. Bank of America's scenario might underestimate how much silver would come to market at prices 50 to 100% above current levels. If supply response is stronger than modeled, prices cap out below the $170 target, even if retail flows continue. Bear case 3. Institutional profit-taking could overwhelm retail buying. While retail investors might buy into strength, institutional investors definitely sell into strength. If silver rallies from $80 to $110 to $130, driven by retail flows, every institution holding silver positions from lower prices will be taking profits systematically. Hedge funds don't let 30, 50, 70% gains turn into losses by holding too long. They take chips off the table. They rebalance portfolios. They sell call options against positions to capture premium. Institutional selling creates natural resistance at every major price level, and institutions control far more capital than retail investors collectively. If retail flows are adding $5 to $10 billion per quarter to silver, but institutional profit-taking is removing $8 to $12 billion per quarter, retail buying gets overwhelmed. Prices stall or decline despite continued retail enthusiasm. The $170 scenario requires retail flows to be large enough to overwhelm institutional selling pressure for extended periods. That's possible, but it's not the base case historically. Usually, institutional selling caps retail-driven rallies well before parabolic targets are reached. Institutions have better information, faster execution, more capital, and discipline that retail investors lack. Betting that retail overwhelms institutional behavior for 8 consecutive quarters is betting against historical patterns in every prior commodity cycle. Those 3 bear case factors, retail attention span, supply elasticity, and institutional profit-taking, are the reasons Bank of America presents $170 as a scenario rather than a forecast. They're modeling what happens if current trends continue, but they're not predicting those trends will continue because the forces working against continuation are substantial and historically powerful. This is responsible research. They show you the upside math if conditions persist, while implicitly acknowledging those conditions probably won't persist, which is why this isn't their base case. Now let me show you what the smart money is actually doing with this Bank of America research, because professional investors don't read $170 silver and immediately buy futures contracts. They read the research, extract the analytical framework, and use that framework to inform position sizing and risk management within broader portfolio strategies. Here's how institutional investors likely use this type of scenario analysis. First, they validate the research methodology. They check whether Bank of America's assumptions about Q3 flows, market size, and price elasticity are reasonable. They look at their own data on ETF flows, futures positioning, and physical demand to confirm or challenge the retail surge narrative. They don't just accept $170 as true or false. They evaluate whether the analytical building blocks are sound. If the methodology is sound, even if the specific outcome is unlikely, that tells them something important. Silver market structure is vulnerable to retail-driven squeeze dynamics under the right conditions. That vulnerability matters for risk management, even if you don't expect $170. Second, they use the scenario to inform position sizing within precious metals allocation. Let's say an institutional investor already holds a 3% portfolio allocation to precious metals, split 80% gold and 20% silver. The Bank of America research suggests silver has meaningful upside optionality if retail flows continue, but also significant downside risk if flows reverse. How do you position for that asymmetry? Maybe you keep the 20% silver allocation, but add some downside protection through put options. Maybe you slightly increase silver to 25% within precious metals while maintaining overall precious metals allocation constant. Maybe you do nothing to base case positioning but establish a small tactical overlay position size for the retail surge scenario. The research informs incremental allocation decisions within existing frameworks. It doesn't drive binary all-in or all-out positioning changes. Third, institutions use the scenario to establish monitoring thresholds and trigger points. If Bank of America is right that Q3 retail flows are the key variable, then smart investors monitor those flows continuously. They watch ETF inflow data weekly, they track physical bullion premiums and dealer inventory levels, they monitor retail brokerage data on silver-related trading activity, and they establish decision rules. If retail flows continue above threshold X for Y weeks, increase silver exposure by Z%. If flows reverse below threshold X, reduce exposure. The scenario analysis provides the framework for systematic, rules-based tactical adjustments rather than emotional reaction to price moves. Fourth, institutions look for derivative strategies that exploit the scenario's risk-reward asymmetry. If there's a plausible path to $170, but it's not the base case, that's exactly when option strategies become attractive. Long-dated call options on silver or silver miners offer convex payoff profiles. You pay a relatively small premium for the right to participate if the $170 scenario plays out, but you limit losses if it doesn't. This is how professionals express views on low-probability, high-impact scenarios without betting the farm. Bank of America's research makes the case that $170 is a low-probability, high-impact scenario worth considering. That doesn't mean buy silver spot. That means evaluate whether option strategies offer attractive risk-reward for expressing a view on that scenario. Finally, sophisticated investors use the Bank of America research to identify second-order opportunities beyond just long silver positions. If retail flows into silver continue, which mining stocks benefit most? Which have highest operating leverage to silver prices? Which have investor bases that aren't yet pricing in $170 scenario awareness? If industrial users face sustained high silver prices, which companies have pricing power to pass costs through versus which get margin compressed? If solar manufacturers need silver for panels and silver goes to $130, do solar stocks get hit, or does it not matter to their economics? The direct silver play is obvious. The derivative plays across the value chain are where institutional investors find edge because those opportunities are less crowded and less obvious to retail participants piling into SLV. This is what professional investors do with scenario research like Bank of America's $170 projection. They don't treat it as a prediction to believe or dismiss. They treat it as an analytical framework to inform position sizing, risk management, tactical overlays, option strategies, and second-order opportunity identification across portfolios. The $170 number makes headlines. The methodology and strategic implications make professional portfolios. Now, here's the thing about Bank of America's research that deserves your attention, regardless of whether silver hits $170 or $70. The research highlights a market structure vulnerability that exists independent of specific price outcomes. Silver is a small market relative to potential retail capital flows. Retail access to silver has never been easier. Retail behavior in momentum-driven markets can create self-reinforcing feedback loops that produce parabolic moves.